Good afternoon, everyone, and welcome. I am Ernesto Burden. I'm the publisher of New Hampshire Business Review. Delighted to welcome you to our webinar today. We are going to be joining the team from JPMorgan Chase Commercial Banking as they break down the results of the JPMorgan Chase Annual 2023 Business Leaders Outlook Survey and discuss what's in store for this year. Certainly a time of economic uncertainty for those of us who are managing businesses. I personally am really looking forward to hearing what our speakers have to say. If we could introduce you to them. We are going to be hearing today from Ginger Chambliss, Head of Research for JPMorgan Chase Commercial Banking, and Tom Cunningham, Executive Director of JPMorgan Chase Commercial Banking. Tom is based here in New Hampshire and will be giving us the New Hampshire eye view after Ginger gives us the national perspective on this issue. Today's webinar is also sponsored by JPMorgan Chase. We're grateful for both the wisdom that they're going to be imparting and their support of New Hampshire Business Review and our ability to bring you this presentation today. So with that, we're going to dive in and introduce Ginger, and then Tom will be joining us afterwards, and then we'll move into some Q&A. Do know that there is a question button, so if you want to put in your questions, we'll do our best to get to as many of those as possible after the presentation as well. So with that, Ginger, welcome.
Great. Thank you so much. And it's my pleasure to be here today. And I do have a brief presentation I can go through, which will provide a summary of our key findings from our Business Leaders Outlook Survey. It's a survey we've been doing, JPMorgan Chase Commercial Banking has been doing for the past 13 years. We go out and survey a range of small and mid-sized business leaders to get their views on the economic landscape, how they're thinking about their businesses and prospects in the year ahead, how they might be thinking about some of the key challenges facing their businesses, and then some of the plans that they have in place with regards to navigating the economic landscape. So let's dive right in. We can go to the next slide. So I'll start big picture. And while our broad outlook for the economy incorporates slowing growth this year, we think if the US does go into recession later this year, it will be much milder than the last two recessions for a couple of key reasons. First, both the household sector and businesses have healthy balance sheets. So they're entering the year on a solid foot from a financial standpoint. Leverage is less of a concern than it was leading up to the 2008, 2009 downturn. And then the US labor markets, which by many metrics are still the strongest on record. And so this is coming through with indications that businesses may be more reluctant to conduct layoffs, considering how challenging it's been to find workers over the past 18 months. And there's still historically high levels of open jobs. But just to put some numbers around this, here in the US, we see real GDP growth of about 1% for the full year of 2023. That's our forecast. In context, this would be a deceleration from approximately 2% growth in 2022, 6% growth in 2021, and below the longer-term average annual growth rate of about 1.8%. So obviously, these are broad numbers and incorporate all industries and aspects of economic output in the US. And if we take it one step further, we would expect to see further softness in the housing sector. This has been an area that's been first and foremost impacted by the higher interest rate environment. Some headwinds on exports in the goods sector, given the stronger dollar, and then continued upside on a relative basis for the services side of the economy, relative to goods as this continues to normalize post-pandemic. So it's not surprising that our findings from the BLO survey indicate that business leaders' optimism around the global, national, and local economies is the lowest in recent years. And roughly 2/3 are expecting recession in 2023. But it is notable that even with this downbeat view of the economy, over 60% of business leaders expect revenue growth in 2023, and 51% expect profit growth as business leaders continue to drive their businesses forward. They have plans in place for new products and services, strategic partnerships, M&A, and geographic expansion, to name a few. So let's flip forward to the next slide and spend a minute on what's going on with monetary policy. This has been a big part of the economic story in the US over the last year. So while we're in a historically steep hiking cycle, as the Fed tries to rein in inflation that was running at 40-year highs for much of last year, we do think we're reaching the end game with 2 more 25 basis point hikes expected before the Fed goes on pause later this spring. If our forecast is correct, this would put the upper bound of the Fed funds rate at 5%, up 475 basis points from where we were early last year, and obviously well above the 2.5% deemed neutral and also the 20-year average, which are much lower. Something else to consider with regards to monetary policy and the tightening of financial conditions is the unwind of quantitative easing. And this is a process where the Fed is rolling off assets from its balance sheet at roughly $95 billion a month. So over the course of 2023, this program will result in the reduction of roughly $1 trillion of liquidity from the economy and capital markets. Along with the move higher in the Fed funds rate, we've also seen market-based rates move. So the 10-year Treasury is the highest in 13 years. The 2-year Treasury is the highest in 15 years. And of course, mortgage rates have been moving significantly higher too. They're in the mid 6% area now from about 3.25% around this time last year. So the highest in 20 years, and it's clearly having a challenging impact on housing activity, which has dropped sharply over the past 6 to 9 months. The move higher in interest rates is also being felt by business leaders, with 60% citing higher interest cost, which is up from under 40% at mid-year. We also found that nearly 25% of respondents are planning lower CapEx in the year ahead. This is the highest percentage we've gotten from the survey outside of the surveys that were taken during 2020. Now that still means that 3/4 expect CapEx to be stable or higher. So it's not all bad news, but just to put that into some context. We can move forward to the next slide and we'll shift gears here and talk a little bit about some of the other forces that are shaping the outlook, namely some of the challenges that business leaders have been navigating the past couple of years and how they're thinking about things more recently. So inflation, labor, and supply chains have really been the top 3 challenges facing business leaders. And in this most recent survey, inflation was really cited as the top challenge, with 91%, a very large majority of mid-sized business leaders talking about experiencing inflation challenges and rising costs. Really no surprise. Like I said, we've been running at very high inflation for all of 2022. Businesses have been passing through these higher costs, raising prices to consumers on their finished goods and services. Roughly 40% of our survey respondents report to having passed along more than half of their increased input costs, and 82% say they're likely to continue raising costs or continue raising prices, that is, to mitigate these higher costs. Nonetheless, we do think there are several reasons to anticipate a noticeable moderation in inflation over the coming year. Um, Energy prices are coming down quickly. Grains and metals prices are off their earlier peaks. And this is starting to be reflected in some of the headline inflation metrics. The December 2022 inflation was the lowest month out of all of 2022. So it's headed in the right direction. Second is that we have seen some progress and easing around supply chain bottleneck pressures. This is helping to contribute to goods prices coming down. So this is starting to roll over. And really one of the most dramatic examples of this would be what happened to used car prices. So this time last year, used car prices were tracking 40% higher than the prior year. In December, used car prices had fallen 14% below the prior year. So a big swing in the prices there. Overall, we see headline inflation on both a core and headline basis retreating to somewhere in the 3% area by the end of 2023. And while this would still be above the Fed's longer term target of 2%, we think it'll be enough for the Fed to pause in raising rates. And it would certainly be a noticeable slowdown from the monthly average of 8% in 2022. So turning to the next slide and the topic of labor markets, by some measures, the US is still facing some of the tightest labor markets on record. We continue to see very low jobless claims and above average, albeit moderating pace of monthly payroll gains. Over 10 million open jobs still in the US economy, which is 40% higher than pre-pandemic levels. We see elevated rates of job switchers and rising wages. All of these things point to the fact that demand for labor continues to exceed supply. Accelerated retirements during the first part of the pandemic and reduced immigration patterns, stimulus and government policies, and ongoing demographic headwinds have all contributed to the labor constraints of the past 18 months. While an increased number of businesses are investing in automation due to the current tightness in labor markets, 2/3 plan to increase wages and benefits to attract and retain talent over the next year. And in my view, one of the most interesting data points coming out of the survey this year is that despite a lot of pessimism around the economic outlook broadly and 2/3 expecting recession, only 12% of business leaders we surveyed actually expect to reduce headcount over the coming year, and a majority expect to add workers. This ties to the beginning of my comments of why a potential recession over the next year could be relatively mild, because if we don't see a sharp rise in unemployment, consumer spending likely holds up relatively well. And then the last topic I'll touch on today, and potentially where we have the most encouraging news, and we can flip forward to the next slide, is around what's happening with supply chains. So while we're not functioning back to pre-pandemic levels, conditions have been improving. This time last year, we were talking about the logjam of container ships outside the ports of LA and Long Beach and the skyrocketing ocean freight prices. And while conditions have not fully returned to pre-pandemic normal, we have seen ocean freight prices fall down 80% in the past year, and delivery times have been shortening. So the flow of goods is happening at a more comfortable pace. Based on our survey, business leaders are evenly split in terms of seeing improved or worse supply chain conditions. Strategic stockpiling has been a strategy and the most common adjustment to the supply chain issues, with 50% of businesses we surveyed employing this tactic. But even this is down from 65% in the year ago survey, which shows that the supply chains are less of a concern than they were a year ago. So this brings me to the end of my presentation. I'd like now to turn it over to my colleague, Tom, to give you some more local insights. Thank you.
Excellent. Ginger, thank you so much for that. Greatly appreciate it. And thank you everyone for joining. Thank you to the New Hampshire Business Review. I'm Tom Cunningham, JPMorgan Chase Commercial Banker based in Portsmouth. Been really in New Hampshire the last 5 years, meeting with business leaders, consumers, learning more about the business environment. And it's quite interesting. You know, I think the general sentiment, and there's a lot of overarching themes here, is that business leaders that I talk to in New Hampshire, they feel resilient as they march into 2023. They're very bullish about their own business, as I think they should be. So just a little bit more background on kind of the survey, JPMorgan Chase. So believe it or not, some of you may know, some may not, but JPMorgan Chase has 175 employees in New Hampshire. We've opened 5 branches over the last 4 years. I manage our commercial office in Portsmouth. We're very bullish on New Hampshire, and I think largely it has to do with the industry diversification in the state. If you think about some other states and cities across the country, New Hampshire is very diverse. You know, manufacturing is certainly a large component, but you know, there's professional services, tourism, hospitality, retail, healthcare, distributors, and it's quite unique, as we generally don't see that across the country. And I think that's partly why we're very interested in the state. But in terms of what I'm seeing locally, there's a lot of similar themes. So our survey found, you know, generally speaking, optimism for the global and national economy for mid-sized business leaders. It is going down. It's decreasing. There's a little more optimism with smaller companies, and I can get into that later. Most leaders in the state are anticipating a recession later this year, hopefully mild. That's pretty consistent with the business leaders that I talk to. You know, inflation and labor really are the top 2 concerns. You know, there's a lot of challenges in New Hampshire with inflation. Business leaders are certainly reevaluating their approaches to pricing, you know, sourcing materials from other providers, and really adjusting how they're running their business in the state. As a result of the inflation and rising costs, most of the business leaders, they are passing those costs on to their customers, and they seem to be accepted for now. So we will certainly see if that continues. One of the interesting things with our survey that you know, I thought was unique is the survey. You know, it went out to companies across the U.S. There were 1,800 business leaders that responded, and it was small companies, which we define as businesses below 20 million, and mid-sized companies, which is 20 million to 500 million in revenue. That's really the set of businesses that responded. The smaller companies, which make up a larger portion of the businesses in New Hampshire, they had some different responses, particularly as it related to their view on kind of the global economy, the national economy, and the local economy versus some of our mid-sized business leaders. And I think there's a few reasons for that. You know, as Ginger said early on, balance sheets going into you know, this time were very healthy. They continue to be healthy. Smaller businesses had access to, you know, government SBA loans and programs like PPP and other programs. Small businesses generally have less exposure to international markets, whereas more of the mid-market or middle market companies that we work with that are based in New Hampshire, they do operations across the U.S. and perhaps, you know, in other countries as well. So just a slightly different view there on you know, what they're seeing outside the U.S. Additionally, the smaller businesses in New Hampshire, they typically have just less debt overall in their capital structure. So with the recent increases in interest rates that we've seen, the interest expense associated with that is slightly less versus some of the mid-sized companies that may have more leverage or more debt on the balance sheet. And then just lastly, the smaller companies typically can be more nimble, act a little bit quicker compared to, the mid-size or larger companies. So I think those are really some of the key reasons why we received some different responses across that. And I would say it's all consistent with, the folks that we're talking to here in New Hampshire. Just touching on labor as I think that's, as you all know, just a key issue in New Hampshire is the labor shortage. The survey that we put out said inflation was number one. I think labor is probably the number one concern in New Hampshire. Businesses are doing their best to march forward, but labor shortages definitely continue to cloud the horizon. I think what we found and what I am hearing is that the business leaders in New Hampshire are kind of committed to their employees, to their communities, and they know how important their employees and communities are for them to survive, particularly in difficult times. And this connection between healthy employees and healthy businesses has really come into focus since COVID. We're seeing more and more business leaders respond by new approaches to benefits and attention to mental health and wellness and just room for flexibility in the workplace. And I think the labor force really appreciates that. Additionally, there's new needs. There's a need for increased wages, for bonuses. Folks are appreciating the flexible working hours, the hybrid or remote work, the additional benefits. I think those are all kind of top strategies that are starting to be deployed just to attract and retain talent. Many where it makes sense, they're shifting to a hybrid work model or a fully remote work model, which, can help play into certain strengths on the company or the industry. Some are seeing higher productivity and just helping overall satisfaction with the employee base. Interesting, there's been more and more focus on helping employees find housing, and we have several business leaders that are actually taking it one step further and providing subsidized housing for their workforce. I've heard this from a few folks, and it seems to be catching on, almost kind of like a dormitory apartment style living, where you can live and work in the community if you're unable to afford something today. Thought that was interesting. And just really, as Ginger mentioned, she touched on three things to kick this off that I think are very prevalent in New Hampshire and will help the companies of New Hampshire is, the healthy balance sheets going into COVID and post-COVID and this current environment. Overall, just lower levels of debt and leverage, and then, quite a strong labor market. And I think all those three things really do apply in New Hampshire, despite some of the other challenges on the horizon. The big one we all know, inflation, it continues to be a challenge. It's impacting companies, it's impacting expenses. It's, really a driver of the wage and benefit increase. And to offset and kind of combat this, we're seeing a few different tactics. Certainly businesses can raise prices, but also just make changes to purchasing, to their supplier base. We're seeing more and more automation across the middle market, mid-sized businesses, strategic stockpiling of materials, and just being very cautious and kind of monitoring prices of goods. I think, as a banker, this is when it's really important to have a strong finance team, a strong CFO, just given the current environment to really, do the best they can to kind of take advantage when there's some opportunity here as it relates to kind of tackling the inflation problem. So just wanted to kind of highlight those few things on New Hampshire, what we're doing, what we're seeing. Again, a lot of very similar themes that Ginger touched on and that were shared with our survey apply here locally. I think we probably be in a good position now, Ernesto, maybe to do a Q&A, open it up to the audience.
Absolutely. And thank you, Tom and Ginger. If you wanted to return as well, we can indeed open this up to the audience for Q&A. We already do have a question in there, and but I had one I wanted to start with. And if you mentioned it and I missed it, I apologize. But a couple of times you referenced an all-time sort of high response for the survey for a given question. And I was wondering, how many years has the survey been conducted?
This is our 13th year.
13th year, okay.
Yeah.
And what are some of the things, that jump out as all-time sort of, this is unusual, nobody's ever answered this way before, that sort of indicate we're in different times?
I think a few of the extreme numbers would probably be around business leaders' optimism or lack thereof on the global economic outlook. So that was really, I think we only had 8% of mid-sized business leaders that were optimistic on the global outlook. So 92% are neutral to pessimistic. So I think that is probably one that kind of stands out. But to put that in context, really since the beginning of last year and when the Russia-Ukraine conflict began, and the Fed started hiking rates. This idea, other geopolitical issues as well, and more talk in the press about trade tensions with China and things like that. But just so much conversation around recession. It's really been kind of discussed more than I can remember in any real business cycle. So I think that is just sort of weighing a little bit on the sentiment aspect of things. But I do think we've seen, and Tom spoke to it too in terms of his conversations with business leaders, is there does seem to be a little bit of a disconnect between the way business leaders are sort of expressing how they're feeling and then how they're acting. Because I think if you're truly concerned about a recession and downturn and worried that it's going to be very significant, you wouldn't also be probably planning to hire employees over the next year. Or clearly the economy is going to go in cycles. So business leaders are going to be moving forward with their plans and have strategic plans in place, regardless of where we are in the business cycle. But to me, the pessimism around the economy and the hiring intentions are a bit at odds. And I think somewhat tell us that that the feelings are probably a little bit, maybe overstated and just sort of more reflective of this broader kind of negativity around the economy and discussion of recession for the past year.
It's really interesting because it does have this sort of almost feeling of, not on a business level, but on say a neighborhood level, where somebody says, boy, the world is just in terrible shape, but we're doing fine, right? And
right.
we're planning to put in a pool or something. I was struck also that, the other thing that these very pessimistic expressions sort of belie are the fact that aren't most of these businesses also projecting that they're going to be increasing revenue this year.
Absolutely. That's absolutely right. So and that would be another good point. Now it is we do typically see the pattern that as business leaders are talking about are sort of expressing their outlook around things closer to home, i.e. their businesses and things they can control, they tend to express more confidence and optimism. I mean, I think small and mid-sized business leaders, I mean, I think by nature tend to be, a more persevering and resilient bunch. And so I think that makes sense. And I think too, when it's their business, something they can control, they can have more confidence about that, as opposed to potentially, things that are going on in the external environment.
Wow, I think that's an amazing insight that probably applies to so many things. Like we're optimistic about the things we can control, and pessimistic about the things that feel out of our control. That's tremendous. We have a couple of questions here from the audience to dive into. One is, how does the repayment of EIDL loans affect these healthy referenced business balance sheets? And I think, Tom, you were talking about balance sheets during your part of the presentation, but I'd throw it to either of you.
Yeah, happy to jump in, Ernesto. I think kind of going back to the balance sheet comment, before COVID even, businesses were doing very well, balance sheets were strong. So you typically had companies with good liquidity, good cash, low levels of debt. COVID came, and there were certainly some winners and kind of losers during COVID. But I think a lot of the government programs that came through with COVID helped significantly, whether it be PPP or EIDL. Even with an EIDL loan or something like that, depending on the size of the business, I think generally they were smaller loans. So assuming there wasn't much debt besides that EIDL loan on the business or balance sheet, and the company is still performing, what we're seeing is the cash flow generation of the businesses post-COVID are able to pay down the EIDL along with other, debt or principal or interest expense. I think, again, it really depends on your industry, and where you play in the economy. But we are seeing, repayment of debts, very minimal delinquencies, and just a strong overall business environment. This can change kind of month to month, but overall, the outlook from a bank standpoint is still very strong.
And does that follow along with things, particularly here in New Hampshire, like bankruptcies and foreclosures? Similar trend, right? Yeah,
very similar. I think they've been low for a while, right? At one point, it was the lowest ever. So unless we start to see that needle move, and one of the interesting things at the bank is we can kind of almost see that happening before it happens. And we just haven't seen that level of caution yet, or kind of yellow flag warning sign.
Okay. Another question from the audience, and I didn't see this in the survey, but I wonder if you have any thoughts on the impact of diesel fuel and its impact on prices and growth, and maybe even more broadly, just Ginger, you had mentioned that prices were coming down for in the energy sector in general.
Yeah, I don't have any specific comments on diesel. I mean, I know it's a bit more of a regional dynamic. So Tom, maybe you can jump in after me. But I mean, two things I would say on energy dynamics around the energy markets in general is that clearly we had a big dislocation and supply shock when the Russia-Ukraine conflict began. Oil prices skyrocketed earlier last year. Since then, prices have been have come well off their peak. I mean, our outlook for oil prices this year is that they'll be somewhere in the 90s. In terms of gas prices, so this was another area, it was very pronounced in Europe where gas prices, which are used for heating and home heating and other industrial processes, and concerns around the supplies coming from Russia. Gas prices had really skyrocketed. Now those have come down significantly for a couple of reasons. One, we've had a much milder winter than normal. We're actually talking before the webinar began, but that the Northern Hemisphere has begun 2023 at the warmest since 1950. So that's really alleviating a lot of the demand for gas in these winter months. And then secondarily is that Europe has done a really good job of building up their reserves of gas inventories. So they're in a very good position. There's the concerns of a gas shortage in Europe have mostly dissipated at this point. But Tom, I don't know if you have anything you want to share on diesel in particular.
Yeah, don't have that data in front of me, Ginger. What I can actually do though is I can access our JPMorgan markets right after this and collect that information and then share it. It looks like it came from Peter Brown. So I'll follow up with Peter right after this with our intel from our investment bank.
Great.
Thank you. And Tom, since we're on you, there's another question that was sort of addressed directly to you, presumably with a New Hampshire angle. Are you seeing the rising rate environment cause owners to postpone their 2023 strategic plans?
Not really. I think what I'd say there is a lot of times with increasing rates, there's concern about the need to borrow or finance, something, a project, an acquisition, CapEx, materials. And what I would say is the banks are very much open. The deal you may get today may look a little different than a couple of years ago, but we are very much open for business, open to lend, and hopefully, as you think about your plan for the year, even with rates up, that shouldn't stop you. I think at the bank we think kind of through the cycle, and if we are going to experience a recession or upcoming cycle, we should be thinking through that. You should be working with your banker about strategy around that. And I think the message here is we're very much open for business. Don't let the rising rate environment distract you from going to the market for anything.
Okay. And Ginger, you had mentioned some potential triggers for rates coming down or circumstances in which the rates would begin to come down. So I guess the question is, how long do you see them at the level they're at now? And then what would some circumstances be where we'll start to see them decline?
Sure. So maybe I'll talk about the Fed funds rate, which is obviously set by the Federal Reserve, and then maybe market-based rates. But first on the Fed funds, so we do see that going to 5% at the upper bound after the March meeting. We think they take a pause there. I mean, they may end up doing one more 25 basis point hike in May, but regardless, we would expect a fairly long pause at those levels. This is consistent with what FOMC committee members have said themselves, and I think probably appropriate given kind of how we see inflation tracking and really the need to get that back down to longer term averages. In terms of market-based rates, I mean, one dynamic that is currently in the markets is that there's front-end rates or very short-term rates are at much higher yields than like the 10-year for example. So we call that treasury curve inversion because it's at very extreme levels. But basically what that signals is that market participants expect rate cuts in the future. They expect slowing growth in the economy. So what would it take for the Fed to start cutting rates would be some concrete evidence or proof that inflation is coming down towards their longer term target of 2%. And so it's likely that they will want to see that before they pivot, so to speak. So we expect them to pause. We don't expect them to pivot. Now, if the economy starts slowing, we start seeing wage growth start to moderate from the 5 to 6% range to something more like 3 to 4%. We think that might be enough for the Fed to start lowering rates again. But again, we think that's probably more likely to happen at the beginning of 2024 as opposed to anytime this year.
Okay. We just jumping back to the questions, we do have some questions that came in through the chat instead of the Q&A. So I'm taking a quick look at those. One is that housing is still an issue. What's the outlook like for New Hampshire or, by region, if possible, over the next 18 months? Tom, do you have a sense of that?
Yeah, the housing thing is amazing, isn't it? I'm from the Keene area originally, grew up over in Cheshire County, and kind of looking around the state today and just the limited supply and the significant demand and the amount for which houses are going for it is pretty wild. I think it's a supply and demand question. So I think until there is a significant amount of supply brought into the state, I think it's going to be robust. The interest rate environment might change things a little bit, right? You might see folks not looking to move and stay where they are because they have a really good rate today and they don't want to go shopping for something else. So that might be part of it. And then people might just sit on the sidelines and say, hey, we don't want to pay 6+% mortgage. We're going to maybe just wait till rates to go down before we do anything. So I think it's possible you just might not see supply come back for a while. And until that supply demand imbalance is fixed, I think, it's great if you're a homeowner today, but it's a tricky one if you're a renter looking to purchase, or if you're moving, into the state or into a new location. It's a challenging one. Again, that's just kind of my view. I don't know, Ginger, if you have more broad detail on kind of home building and housing, and anything you want to share just more broadly, kind of from a macro view.
Yeah, sure. Since the housing crisis and sort of overbuilding scenario that took place kind of during 2004 to 2007, really, and then the global financial crisis played out and subprime crisis and all of that. Really, since then, there's been sort of an underbuilding relative to demand for the past 10, 12 years. So available inventory levels are very low. And vacancy rates are very low. So on this, like Tom was saying, the supply side, and I mean, this is true nationally, real estate does tend to be a very local market, and there can be different dynamics in different regions, but big picture, the inventory numbers are very low. We have seen a pretty sharp drop off in housing activity since rates started moving up. And like I said, the 30-year mortgage went from 3.25% at the beginning of 2022 to roughly 6.5% now. At one point earlier, or mid to late last year, mortgage rates were above 7%. So housing activity has fallen anywhere from 20 to 30% if you're looking at building permits, existing home sales, new home starts, etc. Home prices, on the other hand, or home values, have held up much better. home values in December of 2022 were still a couple of percent above the prior year. So they have come down from the peak, which was June or July of last year. But they've so far held up a lot better, and it's because of that tight supply. So we're seeing a little bit of a break between the activity levels, which have adjusted and dropped lower. Home prices have moderated, but really holding up. And really, home prices at the end of December were 33% above where they were in December of 2019, so pre-pandemic. So still pretty elevated over a 3-year period of time.
Would you expect to see those drop eventually if activity stays low?
So we do expect home prices to adjust lower a little bit, and our outlook for kind of residential investment or housing market activity. We do think with rates where they are that we will see another year of soft trends or declines. But we think that on a relative basis, home values and home prices won't see the same magnitude or percentage drop that we're seeing in activity levels.
Got it. Perhaps a related question also from the audience is, Tom, do you see strong investment interest in Manchester specifically? The work being done to reimagine the former mills into nice condos and apartments is encouraging.
It sure is. As we think about the landscape of New Hampshire, the business community, more specifically the middle market, which is where kind of our business is focused, most of those businesses still are situated in and around Manchester. The Seacoast has some stuff going on, and there's stuff in southern New Hampshire, but the core of business is centered around Manchester. The airport is there. A lot of the old manufacturers are still there. So that's really kind of the heart of New Hampshire as I think of it. And so long as those businesses are there and they continue to do well and they continue to grow, the banks are going to be open to lend and support that build out and support the growth of those companies, which should ultimately continue to improve Manchester as a whole, the community. I think, downtown, there's a ton going on. There's a ton of great stuff going on. And I think as the city as a whole continues to kind of step by step go along and grow and grow, the businesses grow, I think the downtown it's just happened. It's a matter of time. So we're very focused on that. We just put a branch on Elm Street last year, so we're excited to be there.
Welcome to town.
Thank you.
How do either of you have a sense of how strong, this again from the audience, is the shift from manufacturing in China to more nearshoring, like in Mexico?
That's such a good question. It is, I think to date, the shift, there is a lot of interest, and there are a lot of advisors and experts at JPMorgan that are spending a lot of time with clients on this very topic. I think it's, that it won't be a quick fix or something that happens over. It's not a multi-month thing. It's a multi-year, I think, situation, but it's something that I would say so far. Changes are probably relatively small, but I think it's something that strategically and it's certainly a big topic of conversation for our clients that have complex and international supply chains. So I think it's something that will continue to be talked about and worked on over the next several years.
Great. So we have another question from the audience that I also wanted to sort of build on, because I think there are a couple questions inside this that are interesting. Generally, do you see the effect of New Hampshire's lack of state income and sales tax on the decisions of folks from neighboring states, especially Massachusetts, to make a move, especially as more remote opportunities open up? So that's sort of question A, and then I think there are some interesting questions to build on out of that. But I suppose, Tom, do you have a sense of that, or?
Yeah, it's I think certainly that has escalated since COVID and the ability to do more remote work. I think years ago people always thought they had to work in a city because that's where the jobs were and they could make a good living. That is slowly changing. So New Hampshire's environment is perfect for someone that wants to be in northern New England, that may be able to still work in Mass or do a hybrid or work fully remote, but work from New Hampshire with no state income tax and no sales tax. There's a lot of advantages to that. And I think this also kind of ties into the housing situation, right, which we touched on earlier. It's all interrelated. So I think at the end of the day, though, bringing more folks to New Hampshire, it's not a bad thing, right? Because then people may decide to start businesses there. It is an interesting topic, though, and I think it's one we're definitely going to continue to see the trend of. Ginger, correct me if I'm wrong, but Tennessee, the tax situation there,
no state income tax, but we do have a high sales tax, relatively high sales tax.
Well, it's that sort of idea of people moving, say, here to Manchester and working in Boston. The other question that it raises for me is, how challenging is that for employers in smaller markets when they're now competing with major urban markets on salary, which may be completely unrealistic for a business that's, say, here in Manchester versus New York? Is that happening all over the country? And is that also driving sort of hiring challenges and driving wages up, as part of it? That was one of the things that I think that was in the survey, was that employers were trying to hire, but also seeing wages being driven up along with other things that they needed to do.
Yeah, no, definitely happening here. I think not only Massachusetts, but folks from Maine coming over the border, Vermont coming over the border. Also seeing it a lot in Florida, right, with folks moving down there, given the tax environment. I think that says a lot about what's going on in the state and how the state is run. And, people want to move here and live here and enjoy it. It is going to be a challenge for the local companies from a competition standpoint, for sure, particularly from a wage benefit standpoint. Wish I had the solution or answer to fix that one, but I think it's something that's been happening for a long time. And I think COVID, like many things, has really just accelerated it, right? Like technology as well is another one. So we'll see.
It may be beyond the purview of the survey, but I'm curious if this leads at some point to a much greater sort of leveling or homogeneity of wages in specific industries, regardless of region or rural or urban location that somebody's in. I realize that wasn't a question so much.
No, it's interesting. It's all about salary transparency, right? And there are now states, New York, California, when they post a new job, they're required to post the salary range, right? And I think this is just kind of on top of that, of kind of creating a more quality in the labor force and system. So we will certainly see. That's a tricky topic, though, right?
Indeed. It seems like you need crystal ball, tea leaves, cards. We are just about at the top of the hour, and I know we weren't even really planning to go that long. So thank you for a really engaging discussion. One last question, I think. comes out of the survey again. And it was, as you conclude the survey, one of the things that you talk about is you recommend recession proofing a business, and you give some guidance on how to do that. And I'm wondering if you said we might be looking at a mild recession, hopefully, and that's certainly what business owners think that we're looking at. So what should they be doing to recession-proof their business, Ginger?
Sure, I can maybe start, and then Tom, I know this is the kind of conversations that you're having all the time, so maybe you can bring it home for us. But I think first and foremost, and when I'm having these conversations, I think one, perhaps a silver lining of anticipating a recession is that it gives you time to prepare. And so really the key thing here, and we've talked about it a bunch already, is having a strong balance sheet, because with a strong balance sheet, good liquidity, that's really going to put any sort of business in a good position to weather a downturn. So that's really number one. I think just being aware and being very in tune with the demand trends, and if you're selling to consumers, how is the consumer faring, and just being very nimble with regards to that. But I do think that with having the pandemic in the recent rear view mirror, there were a lot of contingency plans, resiliency plans, creativity with regards to the business models that are now sort of embedded, and I think will serve businesses well with a potential slowdown later this year. But Tom, I'll turn it to you.
Yeah, no, Ginger, I think you hit it well. I would say it's just a great time to engage your banker, and have your banker, at the table when talking about strategy and thinking about budget and forecasts and working on your modeling and your sensitivity cases and your base case and your optimistic case, and just some what if scenarios. Probably one of the favorite parts of my job is to do that and kind of sit at the table and provide kind of the view from JPMorgan Chase and advice and just what we're seeing more broadly. So that's one. I think the second thing too is, you always want to be prepared for the unknown, but also think of it as a time to be strategic, right? Recessions create opportunity, and different things can arise from the economic volatility that comes with a downturn. So, it all of a sudden could become a buyer's market for M&A and just an acquisition or kind of identifying an undervalued asset in the market. Great time to think about it is now. And again, kind of looping in your banking and financing partners early and often, it can do wonders.
Awesome. Well, thank you. And I know our audience has appreciated you today. They're sending a lot of love your way in the chat. So great insights and much appreciated. Also to the audience, thank you. Great questions. Thank you for being here with us today. And I hope you got as much value out of this and enjoyed it as much as I did. Tom Cunningham, Ginger Chambliss of JPMorgan Chase. JPMorgan Chase, also our sponsor today. Thank you all, and talk soon.